international taxation. So firstly, we should know the various terms of international taxation. International taxation is the study or determination of tax on a person or business subject to the tax laws of different countries or the international aspects of an individual country's tax laws. Systems of taxation vary among governments, making generalization difficult. Specifics are intended as examples and relate to particular governments and not broadly recognized multinational rules. Taxes may be levied on varying measures of income, including but not limited to net income under local accounting concepts, gross receipts, gross margins, or specific categories of receipts less specific categories of reductions. Unless otherwise specified, the term income should be read broadly. Many jurisdictions require persons paying amounts to non-residents to collect tax due from a non-resident with respect to certain income by withholding such tax from such payments and remitting the tax to the government. Such levies are generally referred to as withholding taxes. These requirements are induced because of potential difficulties in collection of the tax from non-residents. Withholding taxes are often imposed at rates differing from the prevailing income tax rates. Value-added tax, VAT, is similar to a sales tax. It is a tax on the estimated market value added to a product or material at each stage of its manufacture or distribution, ultimately passed on to the consumer. These are two fundamental types of tax jurisdiction, the worldwide and the respective territory. In case of national residents of a country, national tax jurisdiction is to tax on their worldwide income, no matter in which country it is earned. A MNC firm with many foreign affiliates would be taxed in its home country on its income earned at home and abroad. If the host countries of the foreign affiliates of a MNC also tax the income earned within their territorial boundaries, there will be the possibility of double taxation, unless there is a mechanism to prevent it. The territorial or source method of defining a tax jurisdiction is to tax all income earned within the country by any taxpayer, domestic or foreign. Income tax systems that tax residents on worldwide income generally offer a foreign tax credit to mitigate the potential for double taxation. The credit may also be granted in those systems taxing residents on income that may have been taxed in another jurisdiction. An overseas alternate of an MNC can be organized as a branch or a subsidiary. A foreign branch is not an independently incorporated entity separate from the parent. Basically, it is an extension of the parent. Consequently, active or passive foreign source income earned by the branch will be consolidated with the domestic source income of the parent for determining the parent's tax liability, regardless of whether or not the foreign income has been repatriated to the parent in the foreign country. Transfer pricing refers to the setting, analysis, documentation, and adjustment of charges made between related parties for goods, services, or use of property, including intangible property. Transfer prices among components of an enterprise may be used to reflect allocation of resources among such components or for other purposes. A tax haven is a country or territory where certain taxes are levied at a low rate or not at all. Individuals and/or corporate entities can find it attractive to move themselves to areas with reduced or nil taxation levels. This creates a situation of tax competition among governments. Different jurisdictions tend to be havens for different types of taxes and for different categories of people and/or companies. A fronting loan is a loan by a parent company to its subsidiary through a financial intermediary, usually a large international bank. The bank is a front for the parent, hence the name. The bank makes a profit by charging the parent for being a front. The parent company circumvents host country regulations on the repayment of the loan by the subsidiary on the assumption that the host country is less likely to stop repayment to an international bank than to an MNE. There may be tax advantages if the subsidiary is based in a tax haven. Figure 12.5, which is from page 679 of your textbook, illustrates the cycle of events in a. After studying this lesson, you should be able to Introduction to International Taxation, Tax treaties, the elimination of double taxation. Double taxation avoidance agreement. Method of giving relief from double taxation. Taxation of international transactions. Section 92 to 92F. Maintenance of books of accounts. Section 92D. Now let's discuss double tax avoidance agreement. Double taxation arises when the jurisdictional correction used by different countries overlaps or the taxpayers may have connections with more than one country. Jurisdictional connections used by the countries are of three types, which are status jurisdiction. Jurisdictional connection is the personal status of the taxpayer rather than the source of the income. In the case of companies, fiscal domicile is the jurisdictional test. Tax is paid on global income, that is, income from foreign and domestic sources are taxed. Tax rates are applied on the total global income, canon of equity. Economically advanced countries like US, UK, Germany, Sweden, and Netherlands follow this system. Source jurisdiction. European countries follow source jurisdiction accruing or arising from each source in the country, which is subject to taxation. France, Latin American countries, and some Middle East countries follow this system. Both status and jurisdiction. India follows both the methods. However, unlike source jurisdiction countries, income from each source is not taxed separately, though it is computed under each source. The aggregate income from all sources is taxed applying the principle of progressive taxation, thus satisfying the canon of equity. If an agreement is entered under Section 90, the effect of the same shall be as under. If no tax liability is imposed under this Act, the question of resorting to the agreement would not arise. An agreement cannot impose any tax liability where the liability is not imposed by the Act. If the tax is leviable in our country as well as other country, the income may be taxed in only one country. Or, if income is being taxed in both the countries, then the tax paid in one country is allowed as deduction from the tax payable in the other country as per the agreement. In the case of difference between the provisions of the Act and of the agreement under Section 90, the provisions of agreement prevail over the provisions of that Act and can be enforced by the appellate authorities and the court. Under Section 90 and 91 of the Income Tax Act, relief against double taxation is provided in two, which are unilateral relief. Under Section 91, the Indian government can relieve an individual from double taxation irrespective of whether there is a DTAA between India and other country concerned. Unilateral relief may be offered to a taxpayer if the person or company has been a resident of India in the previous year. The same income must be accrued to and received by the taxpayer outside India in the previous year. The income should have been taxed in India and in another country with which there is no tax treaty. The person or company has paid tax under the laws of the foreign country in question. Bilateral relief. Under Section 90, the Indian government offers protection against double taxation by entering into a DTAA with another country based on mutually acceptable terms. Such relief may be offered under two methods. Exemption method. This ensures complete avoidance of tax overlapping. Tax credit method. This provides relief by giving the taxpayer a deduction from the tax payable in India. Now let's discuss taxation of international transactions. Section 92 to 92F. Conditions for applicability of arm's length price in international transaction are two or more enterprises. An international transaction is subjected to the arm's length price only in case of a transaction between two entities called associate enterprises. Enterprises should be regarded as associate enterprises. An enterprise would be regarded as an associated enterprise of another enterprise if It participates directly or indirectly or through one or more intermediaries in the management or control or capital of the other enterprise. In respect of it, the same persons, namely the persons who have participated directly or indirectly or through one or more intermediaries in its management or control or capital, also participate directly or indirectly or through one or more intermediaries in the management or control or capital of the other enterprise. Deemed associated enterprises are also covered in this section. Computation of the arm's length price can be done through various methods, which are comparable controlled price method, resale price method, cost plus method, profit split method, transactional margin. Under comparable uncontrolled price method, the price charged or paid for property transferred or services provided in a comparable uncontrolled transaction, that is, a transaction between enterprises other than associated enterprises, whether resident or non-resident, or number of such transaction is identified. Such price is adjusted to account for differences, if any, between the international transaction and the comparable uncontrolled transactions, or between the enterprises entering into such transactions which could materially affect the price in open market. The adjusted price arrived at as supra is taken to be an arm's length price in respect of property transferred or services provided in the international transaction. Under resale price method, the price at which property purchased or services obtained by the enterprise from an associated enterprise is resold or is provided to an unrelated enterprise is identified. Such resale price is reduced by the amount of normal gross profit margin accruing to the enterprise or to an unrelated enterprise from the purchase and resale of the same or similar property, or from obtaining and providing the same or similar services in a comparable uncontrolled transaction or a number of such transactions. The price so arrived at is further reduced by the expenses incurred by the enterprise in connection with the purchase of property or obtaining of services. The price so arrived at is adjusted to take into account the functional and other differences, including differences in accounting practices, if any, between the international transaction and the comparable uncontrolled transaction. Profit split method is applicable mainly in international transactions involving transfer of unique intangibles or in multiple international transactions which are so interrelated that they cannot be evaluated separately for the purpose of determining the arm's length price of any one transaction. As per this method, the combined net profit of the associated enterprises arising from the international transaction in which they are engaged is determined. The relative contribution made by each of the associated enterprises to the earning of such combined net profit is then evaluated on the basis of the functions performed, assets employed or to be employed, and risk assumed by each enterprise, and on the basis of reliable external market data. The combined net profit is then split amongst the enterprises in proportion to their relative contributions. The profit thus apportioned to the assessee is taken into account to arrive at the arm's length price in relation to the international transaction. The transaction net margin method. The steps involved in the application of this method are: identify the net profit margin realized by the enterprise from the international transaction. The net profit margin may be computed in relation to costs incurred or sales affected or assets employed or any other relevant base. Identify the net profit margin from a comparable uncontrolled transaction or a number of such transactions having regard to the same base. The net profit margin is so identified is adjusted to take into account the differences, if any, between the international transaction and the comparable uncontrolled transaction. The differences should be those that could materially affect the net profit margin in the open market. The adjusted net profit margin is taken into account to arrive at the ALP in relation to the international transaction. As per section 92C3, where during the course of any proceeding for the assessment of income the assessing officer is, on the basis of material or information or document in his possession, of the opinion that the price charged or paid in an international transaction has not been determined in accordance with subsections 1 and 2. Any information and document relating to an international transaction have not been kept and maintained by the assessee in accordance with the provisions contained in subsection 1 of section 92D and the rules made in this behalf. The information or data used in computation of the arm's length price is not reliable or correct. The assessee has failed to furnish within the specified time any information or document which he was required to furnish by a notice issued under subsection 3 of section 92D. The assessing officer may proceed to determine the arm's length price in relation to the said international transaction in accordance with subsections 1 and 2 on the basis of such material or information or document available with him, provided that an opportunity shall be given by the assessing officer by serving a notice calling upon the assessee to show cause on a date and time to be specified in the notice, where the arm's length price should not be so determined on the basis of material or information or document in possession of the assessing officer. As per section 92C4, where an arm's length price is determined by the assessing officer under subsection 3, the assessing officer may compute the total income of the assessee having regard to the arm's length price so determined, provided that no deduction under section 10A or section 10B or under chapter 6A shall be allowed in respect of the amount of income by which the total income of the assessee is enhanced after computation of income. Now let's discuss 92D, which states maintenance, keeping of information and document by persons entering into an international transaction. Every person who has entered into an international transaction shall keep and maintain such information and document in respect thereof as may be prescribed. Without prejudice to the provisions contained in subsection 1, the board may prescribe the period for which the information and document shall be kept and maintained under that subsection. The assessing officer or the commissioner appeals may, in the course of any proceedings under this Act, require any person who has entered into an international transaction to furnish any information or document in respect thereof, as may be prescribed under subsection 1, within a period of 30 days from the date of receipt of a notice issued in this regard, provided that the assessing officer or commissioner appeals may, on an application made by such person, extend the period of 30 days by a further period not exceeding 30 days. Now let's discuss implication of section 195. Any person responsible for paying to a non-resident, not being a company, or to a foreign company any interest, not being interest on securities or any other sum chargeable under the provisions of this Act, not being income chargeable under the head salaries, shall, at the time of credit of such income to the account of the payee or at the time of payment thereof in cash or by the issue of a check or draft or by any other mode, whichever is earlier, deduct income tax thereon at the rates in force, provided that in the case of interest payable by the government or a public sector bank within the meaning of clause 23D of section 10 or a public financial institution within the meaning of that clause, deduction of tax shall be made only at the time of payment thereof in cash or by the issue of a check or draft or by any other mode, where the person responsible for paying any such sum chargeable under this Act other than interest on securities and the salary to a non-resident considers that the whole of such sum would not be income chargeable in the case of the recipient, he may make an application to the assessing officer to determine by general or special order the appropriate proportion of such sum so chargeable, and upon such determination tax shall be deducted under the subsection 1 only on that proportion of the sum which is so chargeable. Subject to rules 1754A made under subsection 5, any person entitled to receive any interest or other sum on which income tax has to be deducted under subsection 1 may make an application in the prescribed form 1754A to the assessing officer for the grant of a certificate authorizing him to receive such interest or other sum without deduction of tax under that subsection, and where any such certificate 1754A is granted, every person responsible for paying such interest or other sum to the person to whom such certificate is granted shall, so long as the certificate is in force, make payment of such interest or other sum without deducting tax thereon under subsection 1. A certificate granted under subsection 3 shall remain in force till the expiry of period specified therein, or if it is cancelled by the assessing officer before the expiry of such period, till such cancellation. The board may, having regard to the convenience of assessees and the interest of revenue by notification in the official gazette, make rules specifying the cases in which and the circumstances under which an application may be made for the grant of a certificate under subsection 3 and the conditions subject to which such certificate may be granted, and providing for all other matters connected therewith. Now let us check if you have understood the various concepts discussed in this lesson clearly. International taxation is the study or determination of tax on a person or business subject to the tax laws of different countries or the international aspects of an individual country's tax laws. Right or wrong? Right. Transfer pricing refers to the setting, analysis, documentation and adjustment of charges made between related parties for goods, services or use of property. Right or wrong? Right. India follows only source jurisdiction method for jurisdictional connections as per double tax avoidance system. Right or wrong? Wrong. Now let's revise what we have studied till now. International taxation has become too complex an issue. The issue of international taxation is important for developing countries as they have to perform a balancing act for good governance. Complex tax laws pose problems both in interpretation and implementation. So tax legislation and treaties should be simple and understandable to the common man and those in trade. There is a difference between principles of governance in the domestic field and the same at international levels. Need for the avoidance of double taxation was known in ancient times. Tax treaties may give rise to various tax disputes which domestic tax forums and courts have to deal with. The main problem before such courts would be that there are often no precedents to be followed, since international tax law is still in its infancy.